You know that feeling, right? That pit in your stomach when the market drops suddenly.
Or that one stock you loved just tanks overnight.
Exactly. It's rough. And that's when you always hear it, don't you?
Yeah.
Don't put all your eggs in one basket.
Sounds so simple. Almost like, common sense.
Right. Like something your grandma would tell you.
Yeah.
But it's actually way more than just folksy wisdom in finance. It's fundamental.
It really is. It's a cornerstone strategy, but with, a lot more layers than most people probably think.
Because let's be honest, nothing can totally protect you from those huge systemic shocks, like, say, 2008 or the start of the pandemic. Those hit almost everything.
True. But understanding diversification, how to spread things out intelligently, that's still your best defense against the everyday and sometimes pretty brutal ups and downs of the market.
And that's what we're diving into today. We've looked through the sources you send over, stuff covering the basics, the theory behind it, sector analysis, going international.
And even where it can go wrong. Yeah, quite a range.
So our mission here is to unpack what diversification really means now, why it's so critical for managing risk, how you actually build a diversified portfolio step by step.
And maybe the interesting bit where its limits are. Can you actually overdo it?
Let's get into it. What do these sources tell us?
Okay, first principles, the bedrock idea. Diversification at its core is just about spreading your investment money around, not keeping it all in one spot.
Strategically, though, not just randomly.
Right, strategically, across different areas of the market. Think of it like building a team. You want players with different skills.
So the wins in one area can maybe balance out losses somewhere else.
That's the hope. That's the goal. Building resilience, reducing the overall bumpiness.
I like that kitchen sink casserole analogy from one source. You need different ingredients. It takes effort.
And if you just chuck things in randomly, it might not taste so good.
Exactly.
There's a method.
And the main purpose of that method is what?
Risk reduction. Simple as that. The basic logic is if your investments don't all zig and zag at the exact same time,
then one bad event is less likely to wipe you out completely.
Precisely. You lower the odds of everything going down together.
And looking at past events really drives this home. Like the 2008 financial crisis you mentioned, that was rough.
Brutal. Okay, so the sources highlighted this. If you were 100% invested in the S&P 500 index back then.
That's the big U.S. stock market index.
Right. Your portfolio would have dropped a staggering 37% in 2008 alone. Imagine $100,000 turning into just $63,000.
Oh, yeah, I'm not.
But the sources showed a comparison. What if you'd simply split that $100, say 50-50, between the S&P 500 and fixed income, like bonds?
Okay, so half stocks, half bonds. What happened then?
Big difference. At the end of 2008, that 50-50 portfolio would have been worth around $84,120.
Oh, so still down, but way, way less painful, like $21,000 less painful on that $100.
Exactly. And the key wasn't that the bonds shot the lights out. They probably just held their ground or gained a little while stocks were collapsing.
Their stability made the difference. They didn't move in lockstep with the stocks.
That's the magic right there. Having assets that behave differently, especially under stress.
Which brings us to an important point the sources made. There are different kinds of risk, and diversification doesn't handle them all the same way.
Crucial distinction. Yeah. Two main types. First, there's systematic risk, market risk.
The big picture stuff.
Yeah, the stuff that hits almost everything. The inflation chewing away at value, interest rates going up or down, big geopolitical events, wars, political chaos, currency swings.
It's like a global recession kicking off, or the Fed making a huge rate hike. That affects everyone.
Pretty much. And here's the kicker. You cannot diversify away systematic risks.
Can't get rid of it entirely.
Nope. If the whole market's tanking because of some major shock, owning different stocks, even different types of assets, might soften the landing a bit.
But you're still going down.
You're still going to feel it. It's the price of admission for being in the market. A risk you have to accept.
Okay, so that's systematic risk, tied to the whole system. What's the other kind?
That's diversifiable risk. Or sometimes called unsystematic risk.
Ah, the stuff you can do something about.
Exactly. This is risk specific to just one company or one industry, maybe one country's economy or a specific market segment.
Like a company's CEO gets caught in a scandal, or a new regulation hurts just the energy sector, or maybe a bad harvest hits agriculture stocks.
Perfect examples. Or, the classic risk of putting all your money in one company and it just goes belly up.
Right. That's the risk you're trying to manage with diversification.
Precisely. This is the risk you can significantly reduce, maybe even mostly eliminate, by spreading things out. owning a mix of things that aren't highly correlated.
Correlated, meaning they don't move together.
Right. If they don't tend to go up and down at the same time, a disaster hitting one investment is less likely to sink your whole ship. Others might be doing fine or even going up.
Okay, and there's actually a theory behind all this, isn't there? A mathematical framework.
There is. Modern portfolio theory, MPT, developed way back in the 50s by Harry Markowitz. He even won a Nobel Prize for it.
Wow, so this isn't new thinking.
Not at all. And MPT's core idea is fascinating. It basically says, don't just focus on picking the best individual stock or bond in isolation.
Okay.
What matters more is how adding an asset affects the overall risk and return of your entire portfolio.
So it's about the mix, like building that sports team. Again, not just star players, but how they play together.
Exactly like that. MPT showed you can actually build portfolios that might give you higher returns without taking on more risk, or get the return you want with the least possible risk. It's about optimization.
How does it figure that out?
It sounds complicated.
It uses stats.
Yeah.
The sources mention variance, basically, how much an asset's price jumps around, its volatility.
Okay.
And correlation, how closely two different assets move together. Do they track each other perfectly, move opposite ways, or sort of do their own thing?
And low correlation is the key.
That's where the diversification benefit comes from, according to MPT. Because things don't all move perfectly together, the total risk of the portfolio is less than just adding up the individual risks. It smooths things out, like those shock absorbers you mentioned. Okay, let's revisit the bond example. MPT explains why adding bonds to stocks helps.
Yes. Government bonds, for instance, often have low or sometimes even negative correlation with stocks.
Meaning they might go up when stocks go down.
Or at least hold their value better. So when stocks are having a terrible time, the bonds can act as ballast. Adding them, even a small amount, significantly lowers the portfolio's overall volatility, its variance.
Without necessarily killing your long-term return potential too much.
Right, because those bond gains during stock downturns help offset the losses. It makes the ride much smoother for the investor.
Makes the bumps feel smaller. I think the sources mentioned something called the efficient frontier.
They did, yeah. Imagine a graph. Risk on one axis, expected return on the other. The efficient frontier is basically a curve showing the best possible portfolios.
Just how?
For any given level of risk you're willing to take, it shows the portfolio with the highest possible expected return. Or for any return target you have, it shows the portfolio with the lowest possible risk.
So anything not on that curve is inefficient.
Kind of, yeah. It means you're either taking on more risk than you need to for the return you're getting, or not getting enough return for the risk you're taking. It's about finding your optimal spot on that curve based on your own comfort with risk.
Okay, that makes sense. So MPT gives us the why and the math. Diversification fights that company-specific, industry-specific, risk the unsystematic stuff by using assets that don't move together.
In a nutshell, yes. Aiming for better risk-adjusted returns.
All right, so we get the why. It's crucial. But the how. How do you actually build this diversified portfolio? Sounds like it's more involved than just buying like 5 different tech stocks.
Oh, absolutely. The sources really stress this. Effective diversification is layered. It's not just owning stocks and bonds.
Right.
You need to think about diversifying within your stock holdings, within your bond holdings, where those holdings are geographically, and maybe even adding completely different types of assets too.
Layers. Okay, let's peel that onion. Layer 1.
Yeah.
Diversifying within stocks and bonds. How does that work?
For stocks, a big one is diversifying by sector, spreading your money across the different major parts of the economy.
Like technology, healthcare, financials, energy.
Consumer staples, utilities, industrials, yeah, all those. Each sector reacts differently to economic shifts, interest rates, consumer moods.
So instead of just, say, Apple, Google, and Microsoft, you'd want maybe one of those, plus a bank, a drug company, maybe an oil company, a company that makes soap.
Something like that, spreading the sector exposure. And you can even drill down further, diversifying by industry within those sectors.
And company size matters too.
Definitely. Market capitalization, owning a mix of large cap stocks, the big, stable companies, mid cap stocks, often in a growth phase, and small cap stocks, potentially higher growth, but also riskier. They all have different characteristics.
Got it. What about within the bond part of your portfolio?
Similar idea. Diversify by bond type. Government bonds, like U.S. Treasuries, are generally seen as very safe. Then you have corporate bonds issued by companies. These carry more risk depending on the company's financial health. Municipal bonds from state and local governments. Even high-yield bonds, sometimes called junk bonds, from companies considered riskier borrowers.
And they all react differently to things like interest rate changes or worries about companies defaulting.
Exactly. different credit risk, different interest rate sensitivity. Spreading across types helps manage that. You also diversify by duration.
Duration.
It's a measure of how sensitive a bond's price is to changes in interest rates.
Yeah.
Longer duration means more sensitivity, so mixing durations helps manage that specific risk too.
Okay, so lots to think about just within stocks and bonds. One of the sources laid out a practical process for the stock side using sector analysis. How did that go?
Right, a kind of step-by-step guide. Step 1. Assess the overall market environment, look at the big indexes, sure, but really dig into economic data. GDP, unemployment, inflation, rates.
Get a feel for whether things look generally positive, negative, or just sort of sideways.
Yeah, gauge the sentiment. Is it a bull market vibe or more bearish? This helps you decide if your overall approach should be more aggressive or maybe lean more conservative.
Makes sense. Step 2.
Identify which sectors are doing well right now. You can use sector performance reports, online tools, look for sectors with strong growth, good momentum, positive outlooks from analysts.
So if tech is booming and consumer spending is strong, maybe technology and consumer discretionary pop up.
Could be. Those might be areas you consider overweighting slightly, depending on your overall view from step 1.
Step 3 was about correlation again.
Yep, analyzing sector correlations, back to MPT. How do different sectors tend to move relative to each other? You want sectors that don't all move in lockstep. Low correlation is key.
Because owning 5 sectors that all drop 10% together doesn't help much.
Exactly. The source mentioned how defensive sectors like utilities and consumer staples often have lower correlation with cyclical ones like tech or industrials. Mixing them can provide that cushion.
Right. Step 4, actually allocating the money.
Yeah, deciding your sector weights. You could start with a benchmark, like the S&P 500's sector breakdown, as a baseline.
And then tweak it based on your analysis.
Right, based on your market view, risk tolerance, and maybe which sectors look best positioned for the current environment. The source gave an example for, say, a high inflation, rising rate world.
What do they suggest then?
Well, in that kind of environment, financials might benefit from higher loan margins, energy often rises with inflation, and consumer staples hold up because people still need necessities.
So the allocation might lean towards those.
Potentially. The example was something like maybe 30% financials, 25% staples, 20% energy, 15% healthcare, 10% utilities. Just a hypothetical tilt based on that economic analysis.
Okay. Then step 5 is picking the actual stocks within those chosen sectors.
Right. Now you drill down. Look for companies with strong fundamentals, good earnings, solid balance sheets, and the source mentioned maybe using technical indicators too.
The chart stuff, like moving averages.
Yeah, briefly. A moving average just smooths out the daily price wiggles to show the underlying trend. Is the 50-day average price heading up? The 200-day? Rising averages suggest positive momentum.
And that golden cross.
Right, a specific technical signal mentioned. It's when a shorter-term average, like the 50-day, crosses above a longer-term one, like the 200-day. Technical analysts often see that as a potentially bullish sign.
So if you like the tech sector anyway, and Apple showed a golden cross with rising averages, that might reinforce a decision to buy.
Could be part of the puzzle, yeah. But it's more about timing or confirming within your broader strategic allocation, not the core diversification itself.
Got it. And the final step seems crucial.
Monitoring and rebalancing. Absolutely critical and often neglected. Your carefully chosen allocations will drift over time.
Because some sectors will do better than others. Your 20% tech allocation could become 35% if tech stocks soar.
Exactly. And now you're potentially overexposed to that one area. Rebalancing means trimming back the winners.
Selling some of that high-flying tech.
And buying more of the lagging sectors to get back to your target weights. It forces you to buy low and sell high, systematically. It maintains your diversification.
Okay, that covers diversifying within asset classes using sectors. But you mentioned geography earlier. We shouldn't just stick to the U.S.
Definitely not, according to the sources. Geographical diversification is another vital layer, spreading investments across different countries, different regions.
Why is that so important? Aren't markets kind of globalized now?
They are more connected, yes, but different countries still have their own economic cycles, political situations, regulations, local trends. They don't all move together perfectly.
So the U.S. could be booming while Europe is struggling, or vice versa.
Exactly. That difference in performance is where the diversification benefit comes in. The sources gave good examples.
Like the Europe-only portfolio versus a global one.
Right. If Europe hits a bad patch, a portfolio 100% invested there might take a big hit, say 15% down. But a globally diversified portfolio with holdings in the U.S., Asia, other regions,
might only dip 5% because strength elsewhere offsets the European weakness.
Precisely. It cushions the blow, reduces volatility.
And it's not just about risk reduction, right? International investing opens up growth opportunities too.
Big time. Developed markets like the US are mature. But emerging markets, think India, Brazil, parts of Southeast Asia, can offer much faster growth potential, especially during certain periods. Adding some exposure there can potentially boost your overall returns.
What are the other advantages of going global?
Well, the core benefit is greater diversification, less reliance on just your home market's fate. Access to that global growth potential we mentioned, currency diversification.
How does that work?
Holding assets in, say, euros or yen means your portfolio isn't solely dependent on the US dollar. If the dollar weakens, your foreign assets could be worth more when converted back. It adds another layer of diversification.
Plus, access to unique companies or industries not available domestically. And maybe less risk if there's a purely local, political, or economic problem.
All valid points. So how do you actually do it? For most people, funds are the easiest way. Mutual funds or ETFs that specifically invest internationally or globally.
They handle buying the foreign stocks for you.
Exactly. Takes away the complexity of dealing with foreign exchanges, regulations, etc. You can buy individual foreign stocks directly if your broker allows it, but that takes more research and effort.
What about just buying big U.S. multinational companies? Like Coke or Apple, they sell everywhere. Is that enough?
It gives you indirect international exposure, which is better than none. It's often a starting point for more conservative investors, but it's not the same as directly investing in foreign domiciled companies operating purely in their own markets.
And the sources mentioned other ways too, like global real estate funds or infrastructure.
Yeah, global REITs or funds investing in things like airports or toll roads in emerging markets, more specialized options.
Okay, so how much should someone allocate internationally? Is there a rule of thumb?
Not really a single rule. It depends heavily on your own goals, time horizon, and especially risk tolerance. The sources gave some ballpark figures as examples.
Wow.
Maybe a conservative investor aims for 15-20% international. A more balanced approach might be 30-40%. And someone more aggressive, seeking higher growth and comfortable with more volatility, might go 50% or even higher.
And things like how closely different markets move together, currency outlooks, sector strengths in different regions, those all factor in.
They should, yeah. It's a key part of building that robust, layered portfolio.
Okay, so we've got asset classes, sectors, size, geography. It feels like we're building a pretty complex portfolio here. Is the answer always just add more? More stocks, more bonds, more countries?
Good question. And the answer is probably not. This is where we get into the nuances, the potential downsides. You can have too much diversification.
Really? How much is enough then? Is there a point of diminishing returns?
Definitely. Remember, diversification mainly tackles that unsystematic, company-specific risk. Research highlighted in the sources shows that you get the biggest bang for your buck early on.
Meaning?
One study mentioned found that most of the risk reduction happens with the first, say, 20 stocks you add to a portfolio. Going from 1 stock to 20 slashed risk dramatically.
Okay.
But going from 20 stocks all the way up to 1,000 stocks, the additional risk reduction was tiny, like really small.
Wow. So after about 20 or 30 well-chosen different stocks, adding hundreds more doesn't actually make your portfolio significantly safer in terms of reducing that diversifiable risk.
That seems to be the finding. The benefit plateaus. Owning a massive number of stocks, like some giant mutual funds have to, might not be necessary or even optimal for an individual investor purely from a risk reduction standpoint.
And that leads to the danger of over-diversification.
Exactly. Over-diversification is when adding more stuff actually hurts more than it helps. It happens when the tiny bit of risk reduction you might get is outweighed by the drag on your potential returns.
You dilute your potential winners too much.
That's the main issue. You spread your money so thin that even your best ideas don't move the needle much on your overall portfolio performance.
The courses also mentioned sectional over-diversification.
Yeah, like owning too many very similar companies in the same narrow space, the Pepsi versus Coke example.
Right, their competitors likely move similarly.
Pretty much. Owning both might feel diversified, but you're not really spreading your risk much between those two. You might be better off just picking the one you think is stronger or better valued.
What are the other downsides to being overly diversified?
It just becomes a headache to manage, tracking hundreds of holdings, dealing with all the statements, the tax paperwork. It's time-consuming.
And potentially costly, even with low commissions these days.
Can be if you're trading a lot across many positions.
Yeah.
But the biggest cost is really that dilution of returns. Your winners get lost in the crowd.
This sounds like where those famous Warren Buffett quotes come in. Wide diversification is only required when investors do not understand what they are doing.
Yeah, that sounds harsh, doesn't it? Almost anti-diversification.
It does. How does that fit with everything else?
Well, the interpretation isn't necessarily put all your money in one stock. It's more about focus and conviction after you've achieved sufficient diversification to handle that unsystematic risk.
So once you've got your, say, 20, 30 diverse holdings,
The argument is instead of just adding more and more things you barely know, maybe focus your energy on deeply understanding the businesses you do own. Concentrate your capital where you have the highest conviction. Don't dilute those best ideas unnecessarily just for the sake of owning more names.
okay. So diversify enough to sleep at night, but then focus your attention and maybe bigger bets on the things you really believe in. Find that balance.
That's a good way to put it. Find that happy medium between managing risk and allowing your winners to actually contribute meaningfully.
Makes sense. Now, going back to international investing for a sec. Even if it helps diversify, it's not risk-free, right? What specific risks did the sources mention?
Several key ones. Currency risk is huge. Your investment in, say, Japan might do great in yen, but if the yen weakens significantly against the dollar...
Your return shrinks or disappears when you convert back.
Exactly. You can be right on the investment, wrong on the currency. Hedged funds exist, but at cost and complexity.
What else?
Market accessibility can be an issue. Different trading hours, lower liquidity in some markets, making it harder to trade, potential restrictions.
And the geopolitical stuff we touched on. Political instability, sudden regulation changes.
Yep, especially in emerging markets. Those risks are just higher. You need to be aware that things can change fast based on local events.
Higher costs sometimes, too. Transaction fees, taxes.
Can be. Using good global platforms helps minimize this, but it's something to check. And different countries have different regulatory standards, maybe less investor protection than you're used to at home. All things to weigh up.
Okay. Any other general practical challenges with managing a diversified portfolio, even if it's not over-diversified?
Just the complexity factor. Even with, say, 30 stocks, bonds, international funds, maybe some alternatives, it takes effort to track, understand what's driving performance, handle the taxes.
It's more work than just owning one S&P 500 index fund.
Definitely. And some products, especially in alternatives, can be complex themselves. Need to do your homework. And maybe the biggest reminder,
What's that?
diversification doesn't guarantee profits. And it doesn't prevent all losses. Specifically, it doesn't eliminate that systematic market-wide risk.
Like the COVID crash again. Everything went down together initially.
Pretty much. A diversified portfolio probably went down less than one concentrated in travel stocks, for example, but it still went down. Diversification helps manage the impact, smooth the ride, but it's not a magic shield against major market tumble.
Right. It handles the specific stuff, not the whole market stuff. Understanding those limits is key.
Absolutely. Knowing what it can and can't do helps you use it effectively.
Okay, this has been incredibly insightful. We've gone from the basic why through MPT, the different layers, the pitfalls. So let's bring it all together. How does someone listening actually apply all this? What are the practical steps?
It really has to start with you. Define your goals. What's the money for? When do you need it? And honestly assess your risk tolerance. How much fluctuation can you stomach without panicking?
That sets the foundation, your personal map.
Exactly. Then try to get a read on the current market environment growth, inflation rates. Let that inform your overall strategic tilt. Aggressive, conservative, somewhere in between.
Then start building, consciously thinking about those layers.
Yes. Diversify across asset classes, stocks, bonds, maybe alternatives like real estate or commodities if appropriate for you.
Then within those.
Geographically, get some international exposure. Within stocks, mixed sectors, industries, company sizes. Within bonds, mixed types, credit quality, durations. Think multidimensionally.
And decide how you'll do it. Pick individual securities. Use funds. A mix.
For most people, using low-cost, diversified ETFs or mutual funds is often the most efficient way to get broad exposure across many of these layers without having to manage hundreds of individual holdings.
Using available tools can help too, right? Portfolio analyzers, charting tools.
Definitely helpful for tracking your allocations and, if you're picking stocks, analyzing trends.
And crucially, this isn't a one-time setup.
No way. Monitor regularly. Check how your allocations have drifted. Rebalance periodically, maybe once or twice a year, or when allocations get significantly out of whack.
Selling winners.
Yeah.
Buying losers to get back on track. Feels weird, but it's disciplined.
It is. And stay informed about what's happening globally, economically.
Yeah.
That context helps you understand performance and reassess if needed.
Why is going through all this effort so important for the listener? What's the real benefit?
It's about making smarter decisions for your financial future. It's about controlling the risks you can control, that company-specific, sector-specific stuff. It helps preserve your capital, which is huge, especially as you get closer to needing the money, like in retirement.
It's about optimizing that risk-return trade-off we talked about with MPT. Getting the best return you can for the level of risk you're comfortable taking.
Precisely. Better risk-adjusted returns over the long haul. And things like target date funds or total market index funds are basically pre-packaged ways for anyone to apply these MPT principles easily.
So wrapping up, it really comes back to finding that balance, that happy medium.
I think so. Diversification is absolutely essential. It's your defense against single points of failure. It provides stability. But chasing extreme diversification, owning a tiny bit of everything,
Has drawbacks. Diluted returns, complexity, maybe not much extra risk reduction after a certain point.
right. The goal isn't just maximum diversification for its own sake. It's finding a sufficiently diverse mix of assets that you actually understand, that align with your goals and comfort level, and that can realistically help you get where you want to go financially.
Being spread out enough, but focused enough for your investments to make a difference.
That's the balancing act. Prudent risk management combined with conviction in what you hold.
Well, this deep dive really put that eggs in one basket thing under the microscope. It's clearly vital, backed by serious theory, and needs careful, layered implementation.
But with limits. It doesn't solve all problems, especially market-wide ones, and more isn't always better. Smart diversification, not just maximum diversification.
Being intentional, informed, and finding what works for you.
So the question for you, listening now, is, thinking about your own portfolio, are your eggs spread appropriately across different enough baskets? Or maybe are they spread across too many, making things complex and potentially diluting your best ideas?
That balance is definitely worth thinking about.
Always.
Thank you for joining us on this deep dive into the crucial world of diversification. Keep learning, keep thinking critically about your approach.
And invest wisely.